This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on the Federal Reserve Act, specifically Section 19, Bank Reserves. It's a complex area, but crucial to understanding monetary policy. Our guest is an expert in this field. Let's dive in. What's the first thing listeners need to grasp about bank reserves?
The core concept is simple. Banks need to hold a certain percentage of their deposits in reserve, either as physical cash or as balances at the Federal Reserve. This seemingly straightforward requirement is the foundation for the Fed's ability to influence the money supply.
So it's not just about safety, but also about controlling the economy?
Precisely. By adjusting the reserve requirement, the Fed can influence how much money banks have available to lend, impacting credit availability and overall economic activity.
And what are some of the key terms we need to understand to fully grasp this section?
Section 19 starts by granting the Federal Reserve Board the authority to define key terms. This includes defining what constitutes a deposit, which is far broader than just simple checking accounts. It also covers defining payment of interest and establishing regulations to prevent evasions.
So the Fed has significant leeway in interpreting these terms.
Yes, and this is important because the definition of what constitutes a reservable liability directly impacts the amount of reserves a bank must hold. The broader the definition, the more reserves are required.
Let's talk about reserve requirements themselves. How does the Fed determine these requirements?
Subsection B outlines the reserve requirements. The Fed sets different reserve ratios for transaction accounts, like checking accounts, and non-personal time deposits. These ratios aren't fixed. The Fed can adjust them within prescribed limits to influence monetary policy.
And there are different tiers for transaction accounts based on size?
Yes, there's a tiered system. Smaller transaction accounts face a lower reserve requirement than larger ones. This is designed to provide some relief to smaller banks. The Fed also has the authority to adjust the thresholds for these tiers over time.
The Act also mentions the possibility of waiving these ratio limits under extraordinary circumstances. Can you elaborate on that?
Subsection B allows the board, under extraordinary circumstances and with congressional consultation, to temporarily impose reserve requirements outside the normal limits. This is a powerful tool, but one used sparingly and only in times of significant financial instability.
It's a safety net of sorts, but one that requires a high threshold for activation.
Exactly. It's a last resort measure requiring a supermajority vote within the board and immediate notification to Congress.
What about supplemental reserves? How do those fit into the picture?
The Fed can also impose a supplemental reserve requirement, again with a supermajority vote. This is an additional reserve requirement on top of the base requirement, used to increase the overall level of reserves in the banking system.
So it's a more targeted tool than simply adjusting the base reserve requirement?
Yes, it allows the Fed to quickly increase reserves without altering the base ratios, providing more flexibility in managing liquidity.
Section 19 also addresses reserves related to foreign obligations and assets. What's the significance of that?
This section ensures that foreign operations of U.S. banks are subject to reserve requirements, maintaining consistency and preventing regulatory arbitrage. It covers net balances owed to foreign offices, loans to U.S. residents made by overseas offices, and assets acquired from domestic offices.
Preventing banks from exploiting loopholes to avoid reserve requirements is key to maintaining the integrity of the system.
Absolutely. It's about ensuring a level playing field and preventing the circumvention of monetary policy tools.
Let's discuss how banks actually hold these reserves. What forms can they take?
Subsection C details the acceptable forms of reserves. Primarily, it's balances held at the Federal Reserve Bank. However, the Fed can allow banks to hold a portion of their reserves as vault cash, subject to uniform rules for all institutions. They can also hold reserves in other qualified institutions that maintain balances at the Federal Reserve.
So there's some flexibility in how banks meet their reserve requirements, but it's still tightly regulated.
Exactly. The Fed maintains strict oversight to ensure compliance and prevent manipulation of the system.
Section 19 also includes provisions restricting member banks from acting as intermediaries for certain types of security loans. What's the rationale behind that?
Subsection D prohibits member banks from acting as agents for non-banking entities in making loans secured by investment securities to brokers and dealers. This is a measure to prevent excessive risk-taking and maintain financial stability.
It's about limiting potential conflicts of interest and preventing excessive leverage in the securities market.
Precisely. It's a safeguard against potential instability stemming from excessive speculation.
Section 19 also places limits on deposits member banks can hold with non-member institutions. Why is that?
Subsection E limits the amount a member bank can deposit with a non-member institution to 10% of its capital and surplus. This is to prevent excessive concentration of funds outside the regulated banking system.
It's about controlling the flow of funds and ensuring the stability of the overall banking system.
Exactly. It's a risk management measure to prevent excessive exposure to institutions not subject to the same regulatory oversight.
The Act also addresses the ability of member banks to access their reserve balances. How does that work?
Subsection F allows member banks to access their reserve balances to meet liabilities, subject to Fed regulations and penalties. This ensures liquidity while maintaining control over the money supply.
It's a balance between ensuring liquidity and maintaining control over monetary policy.
Precisely. The Fed needs to ensure banks have sufficient liquidity to meet their obligations, but also needs to control the overall money supply.
What about deductions that banks can make when calculating their reserve requirements?
Subsection G allows member banks to deduct certain items, like balances due from other banks and cash items in process of collection, from their gross demand deposits when calculating reserves. This is to avoid double counting and ensure accuracy.
It's about refining the calculation to reflect the actual liquidity available to the bank.
Exactly. It's a technical adjustment to ensure the reserve requirement accurately reflects the bank's available funds.
The Act also addresses banks located outside the continental U.S. How are they treated?
Subsection H allows banks in U.S. territories to either remain non-member banks, subject to existing regulations, or become member banks, subject to the provisions of the Federal Reserve Act.
It's about extending the reach of the Federal Reserve System while accommodating the unique circumstances of banks in different locations.
Precisely. It's a flexible approach that allows for both inclusion and accommodation of unique circumstances.
Finally, Section 19 also includes provisions for civil money penalties for violations. This underscores the importance of compliance with these regulations.
Absolutely. The penalties, tiered based on the severity and intent of the violation, serve as a strong deterrent against non-compliance. The entire section demonstrates the intricate balance the Fed must strike between maintaining financial stability and fostering economic growth.
That was a great discussion. Thank you for your expertise.